talk about what the fundamental price action, of course, in the market is. What are the fundamentals indicating? We've got Rajesh Bhatia, CIO at ITI Mutual Fund, joining in on the show right now. Rajesh, hi, morning. Good to have you on the show right now. A lot of pieces in the market, and let's start off with defense firstly. We were chatting with the previous expert as well that, structurally, it's a great story. The order inflows as well coming in. But do you think the stocks right now are priced to perfection? What is your own thought?
Yeah, I think you've hit the nail on the head. You're absolutely correct in pointing out that I think it's a no-brainer that defense spending for the next 10 years, given this geopolitical context, the need to increase our independence on defense products is going to increase, and therefore the visibility for spending on defense products is going to be high for the next 10 or 15 years. So I think it's a no-brainer that there's going to be good allocations to defense spending. But as you also correctly point out, are these stocks valued at a reasonable price? My answer at least is no. So you look at good business models or good moats in these companies, wait for corrections in the stock prices of defense companies, because it's a long journey. So you can kind of afford to wait, buy those declines and not necessarily as we speak.
Sure, Rajesh. Hi, morning, and appreciate that view on defense. Let's just shift focus and talk about private banks. If you take a look at the earnings, we've had one or two surprises, but not much happening on the banking front. Do you believe a recovery is on the cards in the second half of the year?
Yeah, I think that is a general expectation as well, that the first half was not supposed to be good, given that interest rates, have declined, and therefore the asset book has got repriced, whereas the liability book will take time to get repriced, and therefore there will be a little bit of pressure on their margins. Of course, there has been some concern on credit costs being a little elevated as well, and the credit growth not being as much, because the corporate sector really is borrowing from the bond market or the commercial paper market or the equity market. So to that extent, the corporate lending growth rate has also been a little anemic, and even the retail sector, there's high competitive intensity in home loans, and the other parts also are a little bit stressful, I would say. So there has been, although there has been a little bit of apprehension. So yes, the first half was expected to be a little soft, and the second half is expected to be a little better. But here's the context. See, my sense is that there has been a little bit of pessimism also on the financial names, as we speak, especially the lenders. And my sense is that the financial year 27 will kind of be a year of acceleration. So from a structural point of view, private banks look attractive. Of course, you have to select the stocks in that portfolio. I think there's a comeback bank that looks a little more attractive to me than the rest of the pack. So my sense is, from a private bank perspective, keep your optimism and hope for acceleration in financial year 27.
All right, but Rajesh, let's talk about autos then, because especially in the past 2 days, we have seen all the excitement in this particular sector. Well, of course, backed by the GST news, rare earth magnet issue getting subsided. But what's your sense on the auto pack? Should one really go ahead and find some opportunities right now, or wait for some correction? And the reason I ask this, Rajesh, is because the news flow is positive, but the other concern is that because of this, the consumers can actually go ahead and delay their purchases, coming at a time where the industry is gearing up for the festive season. What's your take, and what within the pack is your liking?
Yeah, I think even if they delay, I think that's a very shorter term problem. I think, so look, it's not only the GST trade that we've been playing in the automobile segment. We are really playing stocks which are benefiting from market share increases. So companies that you like from a structural perspective are the ones that we have in the auto space. So let us say a SUV tractor manufacturer. We've been holding that for a very, very long time. And there's a two-wheeler company that continues to gain market share in various products. We feel that that's a champion two-wheeler company, and therefore we kind of continue to own those kind of companies. Barring of course, the GST is a very good positive. But what I'm saying is that we've extended the time horizon and looking for companies which are gaining market share and which have a very strong competitive moat in the business that they are operating in. So the GST is certainly going to be a positive when it comes, and I'm sure that this is the first step of reforms that the government is going to do. Given that we've already benefiting. Look, if you look at it, you just step back a bit. The macro context of India is very strong. The markets are unfortunately range bound because we are experiencing a slowdown. Very sharp declines in markets only happen when you have a very sharp decline in macro. Fortunately, that is not the case, and therefore all you're experiencing is a bit of a time-wise correction and not a very sharp price-wise correction in the market. Now that you have 100 basis points decline in interest rates and you've already stepped up reforms, particularly GST being the first one, and I'm sure there are many other steps that are to come. Expectations for a recovery in the second half of financial year 26 or 27 are going to be high. So, so one is that broader context that you should be a little optimistic as you move forward. On automobiles, like I said, GST is a positive move, but I think from a broader perspective, the way to kind of go about these things is look for companies which are succeeding and own them for a longer period of time. So that's how I would approach the automobile sector.
What about telecoms? As limited, Rajesh, as the listed pool may be, but given the fact that Reliance Jio has now discontinued their 1 GB per day tariff plan, Bharti has also followed that. More importantly, structurally, that CapEx is weaning off. That was the indication from Bharti, for instance, on the sidelines of their earnings. Do you think these now become part of the core portfolio, if they already weren't?
No, they have to be part of your core portfolio. I mean, for the last 5 years, I think some of these stocks have done extremely well, especially the leaders in this space. This is a fantastic oligopoly. This is a consumer business. It's an extremely predictable business. There's a lot of tariff repair in terms of price increases that is happening, and that is yet to happen. Imagine realizations going up for you 100% over a 3 or 4 year period in any consumer company. That's a massive increase to your profitability. And like I said, there is more tariff repair that is going to happen. You've seen some of that in the last few days as well. And that's going to kind of continue into the next 2 years, if not more. So my sense is there is enormous pricing repair and ability to increase prices. All of that is going to translate into far greater bottom lines. As you pointed out, the capex cycle is also kind of slowing down for them because they've already done most of the larger capex, which means that their free cash flow is going to increase dramatically. So, you should already be owning telecom as a core position. It's one of the best consumer spaces, as far as I'm concerned, to be in, and there's a lot of upside as you move forward as well.
Rajesh, the market, of course, is looking at consumption in a very, very different way right now, right? I mean, there is the food aggregators, there is the new age tech companies as well, which sort of aid consumption in a very different way, not the pure staples as to how we defined it even perhaps 5 years back. So the likes of a PB Fintech, Swiggy, Zomato, Paytm, that entire pool is getting enlarged. Where is it that you find value now?
All of them. All of them. The digital economy is growing faster than the non-digital economy. So these companies which have kind of spent years building their market bases are growing way faster at a time when you are not sure about economic growth momentum. So these are businesses which are just may not be taking a greater share of the market, the cake, but even if the cake is not expanding, they are taking a greater percentage of the cake. So as to say. So the digital economy is growing faster than the non-digital economy, and therefore their growth rates are much higher, even though we are in an anemic growth environment. Also, a lot of these companies have gone from narrative stage to proven business model stage and are ramping up exceedingly fast. The visibility of growth in these businesses is very high, especially as a portfolio. These companies can grow at a fast rate for the next 5, 7, or even 10 years. So given that, they are growing very fast and they are moving to a path of profitability is a very, very good sign, and therefore a portfolio of all these companies makes enormous sense. Most of these are platform companies, so my sense is that the revenue increase as you move forward will be, will a lot of that will translate to bottom line. Again, like I pointed out, in a context of the fact that you are not as sure about economic growth momentum, these things make enormous sense.
Okay, and Rajesh, want to get your sense on your positioning when it comes to some of these oil and gas stocks. Based on your fact sheet, I see that that is one of your top sectoral holdings as of now. With so much overhang coming in on the Russia oil trading front, are you making any changes to how you are positioned in the segment?
So I don't know what fact sheet exactly are you looking at, but I'm not as optimistic. So personally, as a fund manager, I like businesses where I can predict growth, and these have to be growth companies over the next 3, 5, 7 years. If they are less cyclical, like I pointed out, telecom, digital commerce, insurance, if they are less cyclical, even better as you move forward. And I like companies which are gaining market share. So those are the type of areas that I kind of focus on. Oil and gas at this moment is not a favorite area of mine, just to summarize that.
Indeed, but Rajesh, we believe that insurance was one of your favorite areas when you joined us back in May, and you said that you will continue to prefer the health insurance as well as the life insurers as well. But amongst the two, you believe that the private companies will capture the market from LIC, and insurance, life insurance over general and health insurance was your preference. But given that GST likeliness with respect to the GST rates coming down, do you believe that overall as a pack that becomes even more interesting right now?
So, I think you're absolutely right. I think from a preference perspective, I like the life insurance companies. Especially from a structural perspective, look, they had a lot of overhang as far as regulation was concerned over the last 3, 4, or 5 years. A lot of that regulatory overhang is gone. These are companies which have fantastic distribution for insurance products, and this is a distribution product, right? I know I'm in the mutual fund business, and SBI is the largest because they have fantastic distribution. So you're not surprising the banks are the largest even in the mutual fund business. So basically you need great distribution, and of course there is a player where they are gaining market share from. Apart from the fact that India is a very underpenetrated insurance market, there is an opportunity for them on several products to grow their market and as well as profitability. So from a structural point of view, for a 4, 5 year perspective, I think these companies, which are banks, are very well poised to kind of continue to gain market share as they have for the last 10 years. You should see how some of the leading life insurance companies have grown market share over the last 10 years. It's been fantastic. So my sense is that journey will continue even as we move forward. So from a 3, 5 year perspective, again, I would say the life insurance companies are more attractive. The general insurance companies face a lot of competitive intensity. There are some challenges in the health insurance sector in terms of claims, etc. But generally speaking, again, that's a very underpenetrated area. This is like investing. You need a disciplined player in the general insurance segment. So and I think there's a leading general insurance player which is extremely disciplined in terms of its underwriting, which I like. So that's again for me there may be a little more cyclicality to that, but I would say that that's again a general insurer that I would want to back for the next 3 to 5 years. But look for underwriting discipline. It's just like investing to generate alpha.
Sure. Okay. Great to have you then on the show, Rajesh. Always good chatting.